We're very delighted to host you again on our webinar today, this third day of July. I'm sure many of you have been attending the various webinars we've hosted over the last few weeks and months. Hopefully you have had the opportunity to learn a number of interesting things, and I also hope that you have received quite a bit of guidance to help you respond to the COVID-19 crisis, and also prepare yourselves and your organizations for recovery from the pandemic. So today, I'm delighted once again to bring, to introduce to you our presenter for this webinar. I'll be introducing him very shortly, but I'll start with a brief overview of what we want to cover today at this webinar. Of course, the pandemic has affected different organizations and has had some impact on your operations and revenues as well. And certainly many entities will be experiencing challenges in delivering on various contracts, and these have come as a result of disruptions to supply chain and various restrictions that have certainly affected the ability of many organizations to deliver on their contracts. So the standard, as you're aware, deals with how you recognize and account for revenue from contracts that you have with customers. So there'll definitely be some challenges coming up as a result of the crisis. So we hope that within this webinar, we'll be able to help you address these issues and be equipped to support your clients. Throughout this webinar, we should be able to gain some general knowledge on IFRS 15 and the requirements of the standard and how to implement it. We should also address some of the compliance issues that come with implementation of the standard, and deal with disclosure requirements as related to the standard. And as I mentioned, also address COVID impact on application of the standard. So on that note, I'll now take the honor of introducing our presenter. Our presenter should be very well known to all of you. He has presented several times at ISPAU events. He's a very seasoned practitioner, accountant and auditor. He is a partner at Ernst & Young. Julius Rajekare, CPA Julius Rajekare joined EY in 2004. And before that, he had just completed his training as a pharmacist at Morago Medical School. He holds a master's degree in business administration, an MBA. He also has a Bachelor of Science degree in applied accounting. He's a certified public accountant. He has had a very wide experience across very many industries in the East African region. He has worked for EY Uganda, EY South Sudan, and is currently based in EY Tanzania, but also supports clients in EY office in Uganda. He has, as I mentioned, served various strategic and large clients across the East African region, and been instrumental in developing accounting and audit skills for the staff at EY, but also for a number of clients in the oil and gas sector. He has attended a number of professional development courses, including the Harvard Leadership Program, Communication Masterclass, and several EY Global Leadership Programs. So ladies and gentlemen, it's my pleasure and honor to introduce to you CPA Julius Rajekari, who will now take us through the rest of the presentation on IFRS 15. Julius, you're very welcome, and thank you for making time to support the Institute.
Thank you, Mark. I will now share the presentation that I use. For the discussion, just before I get into the technical discussion, I just wanted to set the context of what we are dealing with. As Mark rightly said, the pandemic has impacted almost everyone, every business. Some sectors are impacted more than others in very many aspects. However, aspects like supply chain disruptions, changes in consumer behavior, restrictions have direct impact on how businesses sell, how much they sell, and possibly even how they contract. And one of the key things that we have to consider as accountants is the impact on revenue and how revenue should be recognized. So I'm going to start with a refresh of IFRS 15. This being a new standard, some members may not be very familiar with the theory of the standard. And then after that, I talk some specifics about the impact of the pandemic and how revenue, accounting for revenue could be impacted. As you all remember, there are very many standards and interpretations that provided guidance on accounting for revenue. But these were combined into a single standard, the IFRS 15, which was co-developed with the American standard setters. And I will be talking about certain aspects that are reflective of that process, that are business practices that are more American than Europe or Africa. The standard deals with contracts with customers, but also guidance on sale of non-financial assets that are not output of the entity's ordinary activities was included. Aspects like sale of property, plant and equipment, intangible assets. Such aspects did not have any explicit guidance in the standards before. The standard was effective 1st January 2018. And by now, entities have applied it for 1 year, and 2020 is the second year of application. The objective of this standard was to remove inconsistencies and general weaknesses. As I said, the number of guidance, most of them were issued to patch up weaknesses as and when users reported to the ISB, but also to generally improve the framework and make it more robust and reflect current business practices and revenue contracts. Improve disclosure requirements and generally improve comparability by eliminating options and clarifying guidance where there was none. This standard is a big deal because it's not an easy one, as we see, but also involves a lot of estimation and use of judgments. It's basically, there's no black and white answer. So it's the judgments and assessments that are done by the reporting entity. In line with the theme of this presentation is that COVID-19 will certainly have an impact by increasing the level of estimation and judgment that is required as we account for revenue. So getting into the core of the standard, firstly is to note that the core principle of the standard is to recognize revenue for the transfer of promised goods or services to customers in an amount which the entity expects to be entitled. So this is a marked departure with the previous practices where you would recognize revenue when risks and rewards have passed to the customer, and the amount of revenue was based on the fair value of the consideration. So those aspects are now just some of the factors you consider as you recognize revenue, and rather than the substantive factors that drive revenue recognition.
Sorry, Julia, just to interrupt. Your slides, are you sharing your slides just yet?
Yes, Mark, I'm sharing the slides.
Thank you.
Is it okay?
Yes, we can see the slides now. Thank you.
Okay, apologies. So you're saying that the core principle is to recognize revenue for the transfer of promised goods or services to customers in an amount which the entity expects to be entitled to. And the standard defines a 5-step model that has to be followed as before you record revenue. And I will unpack each of these steps shortly. So the first step is to identify the contract. So we are required to consider some attributes of a contract in the context of revenue recognition. So there should be parties, and the parties should have approved the contract and are committed to perform the contract. In terms of approval, this could be written, could be oral, or could be implied. We're all familiar with written contracts, but perhaps less familiar with oral or implied contracts. The oral contracts are quite prominent in the Americas, less so in our environment, but we also have a number of cases where the contracts are really oral. For example, basic example, if you jump into a taxi and you negotiate the fare, it is agreed orally, but understood that that will be enforceable. If you get where you're going, you are required to pay the fare that was agreed. An example of an implied contract is if you walk into a restaurant and sit on a table and you're served food and consume the food. After that, it is implied that you pay the bill that will be given to you. The standard also clarifies that there is no revenue contract if both parties can cancel without penalty. This again goes to the commercial sense of the contract. If you can't cancel it, it means there is no obligation to perform. There is no commitment to perform the contract. Another attribute is that each party's rights and payment terms should be identified in the contract. Emphasize that this can be oral or can be implied. In terms of implied, these can be based on business practices. They can be general statements that have been issued by the seller or legally acceptable ways of doing a business. The contract should have commercial substance in the sense that there has to be economic benefits flowing to the parties to the contract. If there are no economic benefits, then there's no business sense. So there's no point in accounting for such a contract. Collection of consideration must be at least probable. and I discuss that further shortly. So you are required to assess this criteria at inception of the contract, and to the extent that the criteria is not met, you don't account for that contract under this standard. You continue to reassess until when the criteria is met. So in terms of the collectability criterion, so the standard requires that you consider the customer's intent, both intent and ability to pay the amount of promised consideration. I talked of probable. This takes the same meaning in the standard, which is more likely than not that the customer is willing and has the ability to pay. This marks a distinction in the previous practices where you would recognize revenue irrespective of whether it was probable that the customer would pay. But now it is clear that if you already anticipate that the customer will probably not pay, then don't bother recognizing revenue. One could think that you recognize revenue and then impair the receivable, but that is not allowed anymore. So if you consider this scenario where an entity, as part of a marketing strategy or corporate social responsibility program, sells some products to some customers, but a number of those customers do not have sufficient startup capital, and as a result, a number of these sales occur on credit with significant uncertainty as to recoverability. So the question is, how do you account for such a contract? So there are different options to consider so far from what we've discussed. Firstly, you have to consider whether the contract has any commercial substance. If the economic benefits are not expected to flow to both parties, then the contract would lack commercial substance. And so you don't even account for that contract. You could consider recognizing revenue and a receivable, then impair the receivable per IFRS 9. As I've just said, if it's already not probable that we collect from the customers, you shouldn't recognize the revenue. Or the option, you could recognize revenue to the extent of collections from vendors that are probable, meaning that as you sell, if you say you are selling 100, you know the customer will probably be able to pay 50. So your pricing is indeed 50, and you recognize to that extent. You could also possibly consider those customers that pay in cash. There you outright recognize revenue. And those who you assess that the credit risk is not significant, then you possibly recognize revenue. So for a contract like this that could seem basic, you can see that there's a lot of considerations that have to be done. You're possibly wondering how you would assess all the contracts, especially for entities that have millions of revenue contracts. But the standard does consider this. It requires that you combine some contracts, if contracts are negotiated as a package, and some of the goods or services promised in the contracts are a single performance obligation. I will talk about what a performance obligation is later. You also may combine contracts into a portfolio and assess at portfolio level if it is reasonably expected that the effects on the financial statements would not materially differ. In practice, there are modifications to contracts, so you may assess a contract at inception, but then you modify the contract. The guidance provided is that accounting for modifications are determined by the attributes of the remaining goods or services. where the additional goods are distinct and at their standalone selling price, you account for that as a new contract, as a separate contract. If not, then you account for the contract as the old contract, but with some considerations which could result into changing transaction price or not. So the second step is to identify a performance obligation. So a performance obligation is a promise to transfer a distinct good or service, or it could be a series of distinct goods or services. Two steps should be followed. You first consider if the good or service is capable of being distinct. An example is if you buying a computer off shelf, a laptop, and you need software, you need basic software, say Microsoft Office, that could be considered that the two, the good, the computer, and the software are capable of being distinct because they can be sold separately, you can buy them separately, and indeed you can benefit from both separately. In some situations, you find that the goods or services are not capable of being distinct. For example, if it is a specialized computer that requires specialized software and you are the manufacturer, so such a good and service would not be capable of being distinct, so you consider it as one performance obligation. So where goods or services are capable of being distinct, the next step is to consider whether they are indeed distinct in the context of the contract. In this, in this you consider whether the goods or services are integrated, highly dependent, or highly interrelated. Again, an example is if you order for goods from a supermarket that delivers, and your order is conditional on delivery. If the supermarket won't deliver, then you won't buy. Such a transaction that combines the sale of goods and transport or delivery services could be considered to be not capable of being distinct in the context, but in practice, the two could be distinct. The sale of goods and transport services could indeed be capable of being distinct. When considering performance obligations, you're also required to consider whether the selling entity is the principal or an agent. A principal is the entity that provides goods or services, and we therefore recognize revenue on gross basis, while the agent arranges for another party to provide goods or services and recognizes revenue as the commissions earned. So what is changed compared to the previous guidance is that who controls the goods or services before they transfer to the customer is the key consideration. The other indicators are that the entity that is primarily responsible for fulfilling the contract is the principal, the entity that carries inventory risk, the entity that establishes prices, and the entity that is exposed to credit risk. In some cases, this is clear apparent. If you think about the agents in telecommunications, we have agents who vend airtime and other products. Those will be clearly agents. But in some cases, it is not easy to determine whether it's an agent or principal relationship. For example, some manufacturers place their products in a supermarket, and the supermarket will not have inventory risk. If the goods are sold on credit, they not carry credit risk, and the pricing could still be controlled by the manufacturer. So while the goods may be sitting in a shelf in a supermarket, the supermarket could be just an agent. But also you find some sections in a supermarket that are largely independent, but everything else seems to be as a single supermarket. So in such cases, you have to go through this analysis and determine whether a supermarket is an agent or principal for some products. The other aspects when you consider performance obligations are rights of return, which come with obligations to refund. These are some of the aspects that have presented headache in 2019 in applying this standard, because there are new aspects in the standard. So a right of return is where you sell. Usually retailers will allow a right to return a product for some reason. If you buy a shirt and it won't fit, then you return it with certain conditions. It could be you are refunded money or exchange for another product, or you can apply what you paid to a future purchase. So such an obligation taken on by a seller is not considered to be a separate performance obligation, but rather a requirement to recognize a refund liability and a right to recover the asset on return by the customer. The other aspect to consider is warranties. These in practice are generally into two types. You have assurance type warranties, where the seller provides assurance that the product will perform to expectations. Such arrangements are considered under IAS 37, where you consider whether you need to record provisions. The other category of warranties are service type. These are usually purchased separately. In a number of cases, you go to a vendor and the vendor tells you buy this laptop or buy this phone. In addition, if you pay $10 extra, I give you a warranty for a year. So such are considered to be different performance obligations. And where they are not priced differently, then you are supposed to allocate part of the amount received to this performance obligation, which would mean that you have to defer recognition of that payment as revenue until when the warranty period expires, or you perform under the contract. The third step is to determine the transaction price. Again, you may think that the transaction price is clear, that it will be defined by going to a supermarket, buy bread, 5,000, and that is the transaction price. Not necessarily. The transaction price is considered to be the amount which the seller expects to be entitled to in exchange for transferring promised goods or services. So the price for the bread, I've said, will depend on whether the 5,000 is indeed for bread only, or there are other hidden services that may be embedded, or there are other aspects that are generally called variable consideration. Other things that could change the transaction price are significant finance components, consideration paid to a customer, and non-cash consideration. I discussed some of these now. In terms of variable consideration, this is where the price for a good or a service changes depending on a number of factors: bonuses, refunds, returns, rebates, price concessions. I've talked about some of these. So we are required to estimate what the transaction price is using two methods: either expected value, where you consider probability weighted amounts in a range of possible outcomes, or you consider the single most likely amount in a range of possible outcomes. You have to choose between the two. You're not allowed to use other approaches. So we are required to constrain variable consideration. This basically means that if the transaction price is not certain, you only recognize it to the extent that it is highly probable that a significant revenue reversal will not be required. An example of this is in the construction industry. You sign a contract with the customer, and they usually provide for claims or incentive payments, or called contingency payments. So as you report over the years during which you implement the contract, you estimate what you think the claims that you're entitled to, even before they are approved by the customer. So you are required to only recognize such revenue if it is highly probable that you not need to reverse it in the future. And there I indicate some of the factors that could result into significant revenue reversal. And this significance is considered at transaction level. So I talked about rate of return, and I said that this is one of the aspects that changes the transaction price. If you buy two shirts, the seller who is selling the shirts will need to estimate the likely returns. For example, could determine that you are likely to return one shirt. So what they do is to record the revenue for one shirt, and then for the other, they record the refund liability and the return asset. Previously, before the standard, the practice was generally to record revenue for two shirts and then wait for when the returns are done. Significant finance component, this arises where the arrangement, the consideration payable has a financing element. For example, if the customer is allowed to pay over 3 years, it is considered that it's not just the price of the good or service sold, but the seller has extended credit to that customer, and therefore there is some financing income that is embedded within the transaction price. So you would be required to determine the financing income by discounting that payment, determining the present value and the difference being recognized separately as financing revenue, rather than revenue from selling that specific product or service. In some cases, vendors pay to customers. Typical examples are vouchers. The supermarkets give vouchers or give gifts. Ordinarily, we think they're being nice and giving us freebies, but it doesn't. In a business, nothing is for nothing. So under this standard, you have to consider whether such payments paid or payable to a customer are a reduction of transaction price, or they could be payments for distinct goods or services. The seller could actually be paying a good or service. Such cases is where, say, supermarket needs products from a manufacturer. They may pay an amount to the manufacturer to entice them to get their products into their supermarket. But we find that in such arrangements, the manufacturer will bring their own shelves because they are separately branded. So you would consider that such payments are indeed for that service of the shelves rather than free things. So if they are reduction of transaction price, these cases where instead of pricing 100, the customer we price 110. So you pay 110, but the 10 relates to the voucher or gift that you are given. So in essence, when you are counting, then you are required to consider that. Another element that affects transaction price is non-refundable upfront payments. These common in the telecommunication sector. Activation fees, you are required to pay some amount before your SIM card is activated. Or membership to clubs. You join a club and you're required to pay a joining fee. Again, the reporting entity has to consider whether this is an advance payment for a good or a service to be provided in the future. And that could be just being available to say if it's the gym being open, that could be the performance obligation. So the reporting entity would not record that as revenue when received, but rather amortize that over the membership period. The fourth step is to allocate the transaction price. By now, if you're following, you would have seen that the amount paid by a customer may not necessarily relate to a product or service that has been handed over to the customer at that specific time. So in some cases, the price paid has to be allocated to determine the amount of revenue to be recognized. And in allocating the price, the standard requires to use standalone selling prices. And these are prices at which the good or service could be sold separately. Usually, it is easy to determine this because the seller will be selling the goods or services separately, and there is a price list, but in some cases not. So where goods or services are not sold separately, the standard requires estimating. But as you estimate, you maximize the use of observable inputs. The standard does define 3 methods, but it doesn't limit to those methods. You can use a combination, or you can use other methods that are reasonable. You could, for example, look at what your competitors are selling, the good or service, and based on that, you could consider the cost of your production of the good and add a margin to determine the standalone price. Example of allocation of the transaction price. So a telecom entity, you sign a contract, a prepaid contract of 24 months. You pay 150 currency units per month, but part of the package is a handset that you pay for at initially 1,000 currency units, monthly entitlement to 100 free minutes and 500 MBs of free data. So the total cash flows from such a contract is 4,600. So the question is how and when you record the 400 4,600 as revenue. So I said that you're supposed to allocate the 4,600 using the standalone prices. So you will see the answer here, what is supposed to be done. You note that, for example, while you pay 1,000, the contract indicates that you pay 1,000 for the handset, the revenue recognized actually is 1,533, and that will be recognized at the time when you hand over the handset to the customer. And as you record the data revenue and the minutes revenue, you still see that the amount that you collect per month is not necessarily what you will be recording. All this means that there is a lot of judgment and estimation, and that certainly you would need to set up systems to deal with these computations. So the last step is to recognize revenue. Now that you know the performance obligations and you've allocated the transaction price to the performance obligations. So the standard requires that you record the revenue at the point when the customer obtains control of the good or service. Control is considered to be the ability to direct the use of or obtain substantial the remaining benefits from the asset or the service. The control could pass to the customer over time or at a point in time. So we are required to consider three aspects of whether control passes over time, and if these are not applicable, then by default, control passes at a point in time. So if the good or service creates or enhances an asset that the customer controls as it is created or enhanced, that would suggest that control passes over time. An example of this is if you are hired to construct a house on the customer's land, as you construct, the control of what you've constructed passes over to the customer. They enjoy the benefits. Basically, if you terminate the contract, then you will not bring down the structure that you put up, and the structure can be completed by another entity or person. On the other hand, you may be contracted to construct a house and hand it over to the customer when complete. So in that case, then you remain with the control of the house, and you will only pass over the house at one point in a time, and that is when you record revenue. So other aspects of recording revenue is, of course, for arrangements where I recognize revenue over time, is to determine how much revenue to recognize during every reporting period. Allowed to use two methods, output method or input method. Output method is where you can quantify the amount of work that has been done during a reporting period vis-a-vis the total output required in the contract, while the input method is where you use the inputs used during the reporting period relative to the total estimated input. We are required to consider the method that most faithfully depicts the performance under the contract. And once you select a method, you're not allowed to change that method in the life of that contract. One element I thought I would talk about is the concept of breakage. This applies where customers make a non-refundable payments for a right to receive future goods or services. Think about you buy data, for example, you buy 10 GB to be used over 3 months. If you've used, say, 90% by the end of the 3 months, then the balance of 10% is rolled forward. So if you've used less than 90%, then you forfeit what you've not used. The question would be, when does the telecom entity record the amount that you pay? So the standard requires that if you expect to be entitled to a breakage amount, which is the amount that the customer has paid for, but will not consume because the period of performance in the contract has ended, then you estimate the breakage revenue and record it over the period of the contract. This is as opposed to waiting until the end of the contract and then determine how much the customer has not used and record the revenue. So this marks a significant departure from the previous practices, and one of the challenging aspects, especially in the telecommunication sector, because they have quite a lot of arrangements which we differ significantly and require robust systems to capture all this. Another concept that was introduced into this standard is capitalizing what is called contract costs, which are incremental costs that you incur in obtaining a contract or in executing a contract. For example, if you are pursuing a construction contract, the costs that you incur, you are allowed to capitalize those costs and then only expense them as you recognize the revenue in that contract. Previously, there was no explicit guidance, and the general practice was to expense those costs as incurred. This asset is recorded on the balance sheet, actually it's supposed to be on the face of the balance sheet, and it should be subjected to impairment and, of course, amortized over the period of the contract. So in terms of presentation, by now you must have noticed that the number of new concepts that are introduced by the standard, which means new account balances in the financial statements. Here I indicate the account balances that you generally expect from IFRS 15. The ones highlighted are the new account balances. Historically, we had trade receivables and US sales and output VAT, but now you see the concept of a contract asset. A contract asset is where you've performed in the contract, but you're not yet entitled to bill. So you cannot record the receivables yet. And this happens in usually long-term contracts like construction. You have constructed part of the house, but you are not yet at the bidding milestone. So you record that as a contract asset. I've talked about the rest of the items as we consider the specific things you consider as you determine the transaction price. The disclosures, they are quite many in the standard. The previous standard was actually almost provided nothing on disclosures. This standard has extensive disclosures, which include some requirements for interim reporting, although not as extensive as for annual reporting. The main categories of disclosures are on nature of contracts with customers, if you have different contracts, you're required to disclose the contract characteristics for the main categories, the significant judgments, the assets capitalized and the basis for capitalization, the contracts they relate to. If you've used practical expedients, this is where, for example, you've not considered a financing element because payments are due within 12 months. And during the transition year, you are required to disclose some transition disclosures. You're required to disclose disaggregation of revenue by segments, by significant category, for example, the type of contracts, geography, location of the customers, whether they are in country, out of the country. If in country, for example, the region, whether it is Eastern, Northern. The customer type, is it private sector, government sector? Contract duration, for example, 1 year, monthly, long-term contracts. Sales channels, whether they are online sales or they are shop floor sales. Again, this is one of the challenging disclosures that most entities have struggled with, and one that has been highlighted by a number of regulators and standard setters as needing to be improved going forward. So in terms of COVID-19, we said that the pandemic has impacted business. You expect a decrease in sales volumes, and some entities will respond by decreasing prices to be competitive, or indeed to accommodate customers who are requesting for discounts in these challenging times. But at the same time, there is pressure to report good results, and that creates the risk of recording revenue before it is earned, or even recording fictitious revenue. You remember that during the session on money laundering, this was one of the aspects that was highlighted as being one of the fraud areas. If you think about how COVID-19 has impacted businesses, then you think about sales channels changing. You have, specifically in Uganda, more sellers going online, receiving sales orders on phone, adopting delivery services. So these changes mean that the point at which the transfer of goods or services could have changed. For example, if you've called a supermarket and you place an order and they deliver the goods to your home, does a control pass when they leave their premises, or does it pass at the point when you take the goods at your home? Also, the nature of contract would certainly change. You find more oral or implied contracts. The contract you place on phone will be processed, and it will be implied that you are going to pay for that contract. What this means is then to think back on your revenue recognition policy and process. The process would certainly need to be changed, and also change the policy in terms of when to record revenue and when the contract is deemed to be in place, and the nature of the contract. The other aspect that has changed is use of online payments, mobile money payments, and these come with some transaction charges. Some of the sellers will load these charges into into the price you pay. Again, the question is whether that element is part of the transaction price. As we've seen, you may need then to split that out and record it separately and not as part of the revenue from sale of the good or service. We also see delayed or cancelled tenders. So you may have been pursuing a contract, but then the tendering process has been delayed or even cancelled, and you are capitalizing the contract costs. So you find that you need to reassess and possibly impair such contract costs. Delayed or cancelled contracts means that if you had received contract liabilities and you expected that you would perform the obligation in a month and the contract is delayed, then you have to consider whether there is now a financing element in the deposit that you are holding. And if so, then you possibly need to account for that. You also have to consider whether you're still obligated to perform. For example, airlines are affected by this. Many people had air tickets, and all of a sudden you couldn't fly, and airlines have these air tickets. How to deal with the payments they received is possibly challenged, but the airlines will need to consider whether they still have obligations to perform. That will depend on the terms that were in the contract. If not, they will be considering breakage revenue to record the amounts they received as revenue, even when they not perform the obligation. If they still hold the obligation to refund, then that will continue to be recorded as a contract liability, but again assess whether there is a financing element. Another aspect to consider arising from the pandemic is the impact on customer management and behavior. Increased incentives and discounts means that you have to revisit the transaction price and consider the incentives allowed. Possibly allow right of return and sale on a consignment basis, again, to try to entice customers to buy more. We've talked about how you account for right of returns and refund liabilities. You possibly sellers will be allowing for longer credit periods, and which means that you need to consider a financing element, but also increased credit risk. And we talked about significant uncertainty in terms of collectability. You may possibly have some contracts that do not have commercial substance and contracts that cannot be accounted for, even when you think you've made a sale. Because of the increased credit risk, some sellers, where possible, will demand for upfront payments. Again, is to ensure that you record the contract liabilities and only recognize revenue when you have performed the related obligation. There will certainly be changes in consumption patterns, and this impacts aspects like estimation of transaction price. When you think about things like rebates, you promise a customer to buy, say, 100 bags, if they buy 100 bags of cement, you give them 10 additional bags. So you need then to account for such rebates by estimating at any reporting period whether the customer is likely to achieve the target. And if so, then you have to adjust the transaction price accordingly and keep part of the payment to cover the additional 10 bags of cement that you have to give to the customer if they achieve the target. This could also have an impact on recognizing breakage amounts. in case customers, for example, customers that were meeting targets that trigger rolling forward and consumed data may either increase or decrease, and that would change your assumptions in determining breakage revenue. So in conclusion is to say that the impact can be significant. You've seen that the standard is not a simple one and involves significant judgment estimation. So you need to plan to collect the information that is required, look at your systems, processes, and implement changes where necessary. Consider the governance and control process. Certainly the sales processes have changed, and those increase the risk of fraud and other irregularities, but also how you record revenue, and that could require close monitoring until things stabilize. And lastly, as accountants, remember to consider the impact on revenue, whether revenue is decreasing and therefore your results decreasing, and then update the stakeholders accordingly. If you're a listed entity, closely monitor this. You possibly could be in the situation of issuing a profit warning. I will pause here for now and hand it back to Mark and wait for questions and comments. Thank you.
Thank you very much, CPA Julius Rajekari, for this very elaborate presentation. Ladies and gentlemen, a virtual round of applause to Julius for ably guiding us through this session. Julius has very clearly articulated the 5-step model in the standard, and he has also labored to explain with a lot of illustration each of these steps and the many considerations that we need to make as accountants, as preparers, but also as auditors reviewing the financial reporting that has been done by the different entities. He has highlighted some of the challenges that may be encountered in applying the standard. He has warned us that whereas the standard looks simple in terms of the principles and the model, it can get fairly complicated and may require a significant judgment on our part as accountants as we deal with the various requirements of the standard. He also highlighted the various disclosure requirements that are now more explicit in the standard, and a vast improvement from the previous standards from which this standard was developed. And finally, he has also explained to us some of what he believes will be the impact of COVID-19 in terms of implementation of IFRS 15, what we should all look out for, and provided some guidance on what we should do to address these issues as they come up. So thank you again, CPA Julius, for this very good presentation. Colleagues, members, I hope you have been posting your questions on the Q&A board, and I will now read out some of the questions and invite CPA Julius to address them. I'll start with questions from CPA Yasin Senkubuge, Sarah Katamba, and Buyondo Hakimu, who were all asking questions around financial reporting for education institutions. And let me try and read out those questions that they asked. So CPA Yasin Senkubuge raises the question that education institutions had charged tuition with the changed economic situation. How should an entity adjust their anticipated revenue given the new evidence that has come with the COVID-19 pandemic, especially if fees will not be collected? Relatedly, Sarah Katamba asks you to explain with some illustration circumstances where students have not paid all their fees in cash, and what are the accounting considerations in that situation, and how should education institution deal with that? Mr. Buyondo Hakimu also asks, what is the effect of financial reporting to academic institutions, especially universities, who went into lockdown before the end of their financial year? They had invoiced their customers and students possibly, but the financial year ended before some of that payment was collected, but also before services were provided, were completed. What is the financial reporting impact in those circumstances? I think, Secretary Julius, let me allow you to address those three related questions, and then I'll give you the rest of the questions that came up.
Thank you, Mark. The two are related questions and quite topical, as the education sector is among the sectors that have been significantly affected. So the contracts that are considered were in place before the COVID-19 impact, and the assessment would possibly have been done that they had commercial substance and the collectability was probable or even certain. So if you look back then to the extent that the invoices had been raised, and we are talking about semesters or terms that you're already in progress, you're perhaps not talking about reversal of revenue, but the main consideration in this case should be the performance obligations. You entered into a contract to provide education services over a certain period, which was cut short. So if the accounting was done right, you would have recorded the school fees as contract liabilities, or commonly in business as deferred income. So you would amortize the deferred income as and when you provide the service. To the extent that you did it otherwise, you possibly may want to consider that. So if it is that, then for the amounts received, they will still carry that contract liability or deferred income. And we do not have yet guidance on whether the schools will resume from where they ended or whether terms are going to be cancelled. And if so, what happens to amounts that had been paid but not utilized? So how you retire out that deferred income that remains in your books will depend on what happens after. If schools are required to continue from where they ended, then they have to complete the terms and semesters. And therefore, as you complete the term and semester, you retire the deferred income. If for some reason it is said, forget about the term, forget about the semester, and the school should not refund, then you are thinking about breakage revenue. You had received money and you not provide the related performance obligation. So you record the revenue. I think that situation is unlikely, considering a number of factors, but it is not impossible. Now, thinking about amounts that had been invoiced, but not yet collected, again, it's likely that you're not looking at a situation of reversing the invoices, but again, you have to think what would have been the entries. Would you have recorded that amount as a receivable in the first place? And if you recorded it as a receivable, I said the next entry would not be revenue to the extent that you've not yet provided the service. If, for example, you are issuing invoices before the term starts, then you can't record revenue because the service, education services will be provided during the term. So you then have to consider, firstly, the entries you passed. I suspect some schools could have recorded it as revenue, but then please go back and look at the initial entries. It is likely that at that point, you would record revenue and again some form of liability, and to the extent that you've not collected, but also you've not performed the obligation, then you are thinking about reversing, offsetting those two entries or balances in your balance sheet. Mark, I hand back over to you. I think I've covered both aspects of that question.
Thank you very much, CPA Julius, and thank you for dealing with those questions. Hopefully, those members have appreciated what they need to do and will go and make the appropriate adjustments. The next set of questions I'll read are from CPA Okurapa and Maurice Agionzi and Nicholas Navende. So the first question is, what are the conditions for revenue recognition? Is the underlying condition or for the contract to be approved by the parties to the contract? Does implied contract apply for accounting practice? And what does this imply for the provisioning aspect if that happens by the year end? If it happens that by the year end, this is not paid by the customer. So CPO Kurapa is asking around implied contracts and the provisioning that might happen in those circumstances and the impact of the year end in terms of accounting for that contract. Then Maurice Agionzi says, at what amount should an entity recognize revenue to depict the transfer of promised goods or services to customers that reflect the consideration to which the entity expects to be entitled in exchange for those goods or services? So Maurice is asking a question on a contract that involves exchange. So what is accounting treatment in those circumstances where the consideration is in the form of goods or services? Then CPA Nicholas Navende asks, there are contracts that were terminated for NGOs due to COVID-19. How should he handle such a situation? And then maybe the fourth question that you can deal with right now is from someone who is anonymous, and his or her question is, what is the significant difference between IAS 18 and IFRS 15? CPA Julius, if you could attend to those 4 questions. Thank you.
Thank you, Mark. Starting with a question about implied contracts. So you recall that I said that a contract can be implied. I think the the question is about contracts that may be in progress but not yet signed, whether they can be implied to be in place. I gave examples of things that should be considered when you're implying a contract. It is got to be reasonable in the business practice, or it is published. The vendor basically has it published in their general publications. So it is not an aspect of abusing this to record revenue for contracts where it is not supported by practice or other guidance that is provided in the standard. Consequently, the standard would not allow you to record revenue if it is probable that you will not collect or you will not even perform. So you have to consider the other factors. What is the probability of collection if this contract is implied? Where contracts are implied, it's usually very clear that that the contract is enforceable. And I gave an example of food you eat in a restaurant. So you see in such a case, you cannot wake up and some not paying. So when you end up with the situations of needing to provide at their end, then it's possibly that the revenue recognition was not correct. Now your auditor would possibly challenge the aspect of revenue recognition rather than the discussion of whether or not you should be considering provisioning for that amount. Maurice's question on where consideration is exchange of goods or services. Yes, correct. This is possible in business, and the standard does provide guidance on that. You basically should determine the value of those goods. You possibly consider the market value or the fair value of those goods, and then use that to estimate your transaction price. Nicholas has asked about NGO contracts terminated. I want to assume that you're talking about donor contracts or promises from donors to donate money to the NGOs. So firstly is to say that this is not within the scope of IFRS 15. IFRS 15 deals with revenue contracts from customers. As I said, you expect economic benefits to flow to either party. And in an NGO situation, I think you have economic benefits flowing from the donor. I don't think the donor does provide any economic benefits to the donor. So in IFRS, actually, there's no direct standard that deals with such transactions, donations received. The closest standard that you can apply is the standard that deals with government grants. But to the extent that the donation is from a non-government entity, it means it is not a government grant and therefore not directly within that standard. But because it's the closest, you find that you are required to apply model your accounting policies based on that. If, again, I think in practice, what I would do goes back to the accounting policy that the NGO applies when you're accounting for donations. Use the same thought process. Do you recognize income on signing the contract? Do you recognize income on receipt of the donation? Do you recognize income on performance of the conditions for the donation received? Because there's no explicit guidance, you could possibly argue that either options is possible, but you have to consider what is most prudent and what fairly reflects the financial position of the NGO. So the last option of record income as and when you perform the conditions in the agreement That is, you record as you spend. And to the extent that the expenditure you've incurred is indeed in accordance with the contract, then that is what I personally find to be the most prudent accounting policy, because you get to match the income and the expenditure. But not to say that it is not prohibited to record revenue and a receivable from donors at the point of signing the contract, but to the extent that it is at least probable that you will receive the donations from the donors. Usually the donors have some conditions within the contract that would indicate that it's not necessarily probable. Also, recording on receipt, you could do that, but it has the aspect of missing the matching concept. So perhaps then you're wondering if you had recorded income on signing the contract, or yes, on signing the contract, or even on receiving the donation, but the contract is terminated. So if it was signing the contract, then again, you possibly relook at your policy, but I would expect that you had booked some form of, again, a deferred income, if you are to be prudent, and then you would be reversing that. But if you've not done that, then you possibly have to rethink the entire accounting policy. If you had received the money and the contract is cancelled, I would assume there's guidance on what you do. Usually the donors will require that you refund the money that is not spent, in which case you refund that. Again, going back to the prudent policy, if you had recorded deferred income, then it is easy to refund. It's easy to account. If you had recorded revenue, then you have challenges in terms of refunding. So the last fourth question was about the key differences between IFRS 15 and IAS 18. Actually, a number of differences. I may say the aspects I've been talking about are largely the differences. The simple ones are more extensive disclosures, like disaggregation of revenue. That is a completely new concept. If you talk about the new account balances, you talking about contract cost of sales, contract assets, contract liabilities, requirements that such balances are presented on the face of the balance sheet. All those differences. The 5-step model was never in IAS 8. It's basically IAS 8 was a basic standard, but remember that there was IAS 11 that dealt with long-term contracts like construction contracts, which also did not provide explicit guidance. The other key difference is that this standard talks about things that we are completely never talked about. For example, how you account for sale of property, plant, and equipment, or items that are not in your ordinary course of business. Mark, back to you.
Thank you, CPA Julius. I will give you the next set of questions, starting with the question from CPA Margaret Nalwoga, who would like you to provide some illustration on how to implement how banks and microfinance institutions implement IFRS 15. Then Ken Mwesigwa Romshana asks this question: with the pandemic, it is difficult to determine the collectability of revenue, especially in the utility industry, where government discouraged enforcement of payment, and yet they need to keep services running. So what is the best approach within the requirements of IFRS 15 on reversal of revenue or impairment of receivables? Robert Bosa asks the question that for the case of insurance business, how will the monthly premium payments for insurance contracts that were not paid during the COVID-19 situation be treated? And then maybe we can also take the question from Edison Salimana, who is asking what will be the effect of IFRS 15 to banks that were instructed by the Bank of Uganda to reschedule or restructure their credit facilities. CPA Julius, let's have you respond to those questions. Thank you.
Thank you, Mark. I ask that I combine the questions on banking sector. So the first one is on how banks and microfinance institutions should account for IFRS 15. Firstly, is to remember that the main business of banks, at least in the Uganda context, is to advance loans or other investment products, which is basically financial instruments. So accounting for financial instruments, including the related income, whether fees or interest income, is not in the scope of IFRS 15, is in the scope of IFRS 9. And possibly that was considered under IFRS 9. So when you get into IFRS 9, then you have to consider how to record interest income and the related fees. Perhaps to remember that in IFRS 9, if the loan is in default, then you compute interest income on the net amount and not the gross amount. But going back to IFRS 15, so some aspects of financial services are indeed contracts with the customers in the context of IFRS 15. You think about any transaction that is not related to a financial instrument would likely be in the scope of IFRS 15. So you do need to go through the model that we've discussed, but usually these are short-term, simple transactions. You basically, in a second, you've gone through that model and you've arrived at the answer that you record the revenue at the basic transaction. If you think about a simple service done by the bank, record revenue as and when you do the service. That could be on-spot service, and therefore the transaction is recorded. So to Margaret, IFRS 15 has not had a significant impact on financial services, and that has been the experience, and I think widely agreed. Usually also the transactions that are within the scope of IFRS 15 are not material to the bank. For recording of interest on restructured loans, again, this is not within the scope of IFRS 15, but go back to IFRS 9 and the guidance, I assume you're considering interest income. The answer will be whether the loan is in stage 1 or stage 2 or stage 3. If in stage 1, stage 2, you still record revenue, interest income using the amortized cost, effective interest rate. If stage 3, use the net carrying amount, which is the gross less the expected credit losses. So the other question was on utilities. It is indeed correct that utilities need to consider this, not just the presidential directives, but there is an aspect of conduct risk, social responsibility. I think the president has said they expect everyone to support the people. Perhaps who supports the supporters is still not answered yet, but correct that you hear of talk people saying don't pay an electricity bill, don't pay water bill. But the question is, how do these utilities sustain performance? How do they keep the service going? And I've seen something as the budgets were being discussed and talking about support to utilities, not sure what this meant or whether this indeed came through. So there are still questions that are unanswered before you get back to how you record revenue. What is going to happen with these bills that have not been paid? Is there going to be some form of support to the utilities? Again, the utilities need to go back to their contracts. For the utilities that operate concessions, need to look into the concession terms, whether there are rights there in such cases of recourse to recovery of loss of revenue in this manner. So firstly, go back to the concession agreements. I want to believe most of the electricity utilities are operating under concessions. For national water, still a challenge. Perhaps there will be government support. If indeed, then you are not talking about collectability being uncertain. So if you've considered all of that and collectability is still not probable, and you are doing that now, the month when you know that it's not probable, then you have to go back to assess whether you should even be recording that revenue in the first place. If not, if you determine that it's not probable, then the standard does not allow you to record the revenue. That may not be correct for all customers. You have to look at customer segments, customer profile. I believe some of the customers will still pay. Most of the consumers actually for these utilities are the manufacturers, industry rather than domestic consumers. But I want to believe that unless an industry has closed down, not many are expected to close down, that they will still consume, and because they need the water or electricity, they should pay, and you have a reasonable basis to say that collection is probable. The domestics that will probably not pay, I think the customer segments can be mapped out and you do the assessment. I would want to think that the issue is not as prominent for supplies made just before pre-COVID and possibly not yet collected, because utilities usually have collection cycles of 30 days or less. The last question is on insurance business, accounting for premiums not paid for. Again, this is not within the scope of IFRS 15, still within the scope of IFRS 4. So the accounting guidance would be within that standard. But what I can say that in all the other standards, we find the concept of uncertainty, probability of collection being a general concept that is applied. And that is derived from the sense that businesses exist to make money, and contracts done should have commercial substance. You should be able to get some economic benefit. So you'll not be surprised if you go back to IFRS 4 and there are aspects like that. If not, then you again are looking at dealing with impairment of premiums receivable and other related assets. Mark, back to you.
Thank you very much once again, CPA Julius. We are running short of time now, so I'm going to pick some 4 or 5 questions that you'll deal with before we close. So let me start with CPA Abaho Bright, who asks that he made credit sales on a sale or return basis, and at the reporting date, some of those customers had not paid for the goods but had the right to return. How should he recognize revenue, if any? Then Mabel illustrates her situation with the fact that ISFE organized a conference. Members paid for the conference, but the conference was rescheduled due to COVID-19 guidelines. So what would be the treatment from both ICPAU and the members' side, the accounting treatment? Then I'll go to the question from CPA Joseph Wambi, who asks you how he should deal with rental income where that has been interrupted by the COVID-19 pandemic. And in this situation, the shop floor size has changed, and there might then be an impact on the original contract with the customer. So how should he deal with all of those various changes in terms of his accounting? And then finally, Patrick Okello, also tenants and rent. He says, for landlords who didn't have contracts with their customers, what happens now that government has deferred payment of rent? How should he account for the rent arrears, given that some of the tenants may not even be working, for example, in an arcade? I think CPA, okay, let me take the last question from CPA Zuriat Nakayenga, who asks, how do you account for retention by the client and supplier in the balance sheet and income statement? How does the retention money affect the cash flow statement? CPA Julius, let's have you answer this last set of questions. Thank you.
Okay, I start with a question from Bright, sale on return basis, consignment sales. So two concepts perhaps to consider. Firstly is you have to first determine that whether you, I assume you considering that you are the principal of the products and not the agent. And then you recall that we talked about the rate of return. So when you sell goods with a rate of return, then you're supposed to estimate the goods that are likely to be returned. So you record the revenue to the extent that you expect the related goods not to be returned. And then you need to book a rate of return asset, which will represent your inventory. You effectively credit out your inventories, but then book a rate of return asset to represent the goods that are likely to be returned. And once the goods are returned, then we debit your inventories again and credit the rate of return asset. You also possibly consider impairment for that asset because the goods will possibly be returned in different condition, and if your contract does not cover such aspects, if goods are damaged or have become obsolete or have lost value in your contract, then it means you would be carrying that loss. You would need to record it as an impairment. So this is one area of estimation and judgment that you apply based on experience of how much this specific customer has returned in the past. But talking about COVID-19, such experience is going to change. So you're possibly looking at new experience. rather than historical experience. You have to update the data that you use for those estimates. Mabel's question about the conference that did not happen, I want to believe that the money received for this conference had been recorded as deferred income or a contract liability rather than revenue, because that is what is required. Money was received in advance before service is provided. That is before the performance obligation was fulfilled by the institute. So the right thing would have been to record that as cash, debit cash, credit contract liability. What happens to that liability depends on what happens to the conference. So one, whether the conference will go ahead at some point, in which case the performance obligation will be fulfilled and revenue recognized. Or the conference does not go ahead. What happens? Does the institute refund the money, or does it eat the money and never gives back the money? It depends on the contract. Does the institute have an obligation to either perform or refund? If it is that, then the institute is compelled and it must refund, in which case they close out the contract liability by debiting it and crediting cash on payment. If the institute has a contract with the members, maybe in some small print somewhere, that says in such cases, you do not get a refund, then you are talking about breakage that members paid in advance. The institute had a performance obligation to perform, which was limited to the day that has been scheduled. If the contract says if it doesn't happen that day, you forget about the payment, then the institute will record that revenue. If they had experience and they expected that it could happen, they would have used that experience even at the point of receiving the cash to record some revenue. If they did not have experience and only waiting for it to happen, then they would record the revenue on the date when the conference did not happen, and therefore they determined that they entitled to the money without performing the obligation. So to the member, it's the mirror of what I've said. If you're entitled to a refund, I believe you should have recorded advance payment in your books, because you've paid out money. It's a prepayment. You've paid out money, you've not yet received the service. So on receipt of the service attending the conference, you would have credited your prepayment and debited expenditure, but that did not happen. So to the extent that you're entitled to either get the service or a refund, then you keep the prepayment until when either happens. However, if it is the situation where your contract says your right was to attend the conference on a specific date and failure to happen, you forfeit the deposit you made, then on that date, you go and expense in your books. And please don't go to ICPA to ask them why they have such a contract in that case. So the other question was about rental income. Firstly, again, to say that rental income is not in the scope of IFRS 15. So you're talking about IFRS 16. You may, if you've been following the discussions, rental payment concessions, cancellations, deferrals is topical, not just in Uganda, globally. And the standard setters have indeed even reacted to this by issuing a modification to respond to this. Why this had to happen is that the IFRS 16 talks about changes in rental contracts or lease contracts that could trigger contract modification, and the accounting for lease contract modifications is rather complex and involving, and because of that, they issued a modification, an amendment to the standard that simplifies how you account for that. So I ask you to get into IFRS 16 and the amendment that has just been issued to follow the guidance in there. What the amendment does is to say you don't have to account for either the failure or modifications to pay as modifications of the lease contracts, but account for the changes prospectively. The other question was on, again, rental arrangements where there are no contracts. Firstly, we've discussed what is a contract. Does it have to be written? Can it be oral? Can it be implied? So I want to think that if somebody is using your premises and you don't have a written contract, I want to think that the right answer is that the contract is either oral or implied. It is not a situation of where there is no contract, at least in terms of IFRS 15. But I said that these arrangements are not within IFRS 15. But IFRS 16 has the concept of oral or implied contracts. So you still have a contract. And legally, if you talk to lawyers, they still tell you that you have a contract. Because somebody is in your house, there's evidence to support that they are in your house because they are in it and they've been paying for the contract. So they cannot deny to say they don't have a contract. So again, the concept of government deferring payments or canceling payments, I think again, the government has not said tenants don't pay, but they've politely asked the tenant, the landlords not to evict tenants, to allow tenants some time to pay. That, of course, has issues of credit risk, but also I think landlords are wondering whether the tenants will be able to pay in the first place. I think, again, you need to go back to IFRS 16 and consider whether you're looking at the lease arrangement not having commercial substance, or you're looking at impairing the lease rentals receivable. The last question is with retention money. This will usually happen in some contracts, so where you need to guarantee is part of the payment that is supposed to be paid to the service provider or supplier will be retained until when, for example, a period of defect has passed. You've determined that there are no defects if it's a construction that the structure does not have any defects. This, you go back to warranties. I talked about warranties. This is the concept of warranties. So you have to assess whether this is an assurance type, whether the service provider is providing assurance that, for example, the structure that I've constructed is not going to have cracks within a period of years. If it is assurance type, this is unlikely to be to impact your transaction price, which would mean you record your revenue considering other factors, but not considering this, which is the amount retained by the customer. If it is the service type, and I said the service type warranty is one which represents services that are provided beyond in this case beyond the construction services, that would mean there is a performance obligation for the supplier to be available to rectify any defects within a period, within the specified period. In that case, you need to estimate the revenue that relates to that performance obligation. Could be the amount retained or may not be the amount retained. You have to do to allocate the price to the different performance obligations using the stand-alone prices as we discussed. Mark, that is the last question in the batch. I will hand over to you again.
Thank you very much, CPA Julius Wajekare. Thank you for the very practical, elaborate, very clear presentation that you have made on IFRS 15. I believe all the attendees, all the participants have learned a thing or two and are now more informed on how to implement the standard, especially in the circumstances of the COVID-19 pandemic. So let's appreciate CPA Julius for delivering a very wonderful presentation. We are going to close in the next minute or so. I will make maybe 3 housekeeping announcements. One is that the Institute has opened entries for the Financial Reporting Awards 2020, and the Institute is receiving financial reports or annual reports from various organizations in all categories or in all sectors of the economy, and you can submit your report for evaluation by completing a form which is available on our website and on the Fireworks website. You can also electronically submit that annual report by completing the form, which is also on that website. So I encourage you to participate so that, among other things, the evaluators can assess how well you have met the requirements of IFRS 15. Secondly, for members of the Institute, election of council members is ongoing, and this will close on the 15th of July. So if you've not yet cast your vote, please do so that you can elect the office bearers for the council of the Institute. Last but not least, we have another very exciting webinar coming up next week on Wednesday, 8th July at 2 p.m. And this webinar will deal with audit quality. We have two very exciting speakers who will talk to us about audit quality from both an SME perspective, but also a big four firm perspective. So we should all be looking forward to that session, and I hope all practitioners, auditors, and all the interested members can come and attend this webinar. So on that note, I want to thank you all very much for your participation. I thank you all for the presentations that you have provided, for the questions that you have submitted. Those of you whose questions were not addressed, our standards and technical support team will reach out to you and provide those responses in one way or another. So thank you very much for your participation. Those who asked about the slides, as usual, we provide the slides to all attendees. For you to qualify for CPD hours, you need to have registered and provided all your details at registration point, but also when you are logging in as a participant, you need to be identified as a participant on this Zoom webinar for you to be able to earn CPD hours and receive a certificate. So please make sure you go through that registration process. Thank you very much. Thank you for your time. We'll see you again next Wednesday for the next webinar. Have a good afternoon. Thank you.